Jameel, thanks for joining us. Now, of course, we know Friday's Non-Farm Payrolls is the one of the key data points for this week. What's your opinion on that particular highlight?
Firstly, thank you very much for having me. So look, the non-farm payroll is scheduled for the conclusion of the week, and I think what the markets and investors are looking for right now is some clarity and direction on how the U.S. economy is performing, because to be honest with you, although President Trump and other political risks are dominating the headlines, there has been a gradual deterioration of U.S. economic data over the past couple of months, and this is making investors wonder whether the Federal Reserve will be able to carry out interest rates rises in another two occasions. So I think what the markets are looking for is some clarity with the NFP performance on how the U.S. economy is performing as we head into the second quarter of the year and the third quarter.
As you say, two data points which have been quite moribund the last few weeks. Q1 GDP of 0.7% in Q1. And of course, inflation in March of just 0.3%, with prices not including food and energy falling by 0.1%, the first decline for core prices in 7 years. So do those data points concern you in terms of where the Fed might be going next?
I think there's definitely some reason to point out that basically there has been a deterioration, maybe on a gradual level, of U.S. economic data in 2017. And while the markets are focusing on President Trump, we are seeing some weakness in U.S. economic data. So the Federal Reserve have quite clearly got a public bias towards raising interest rates at least 2 more times this year. But there has been a slowdown in data. We're seeing the bond market improve, so this suggests that investors are thinking that maybe the Federal Reserve will be hesitant. So what we need to do now is watch out for more data releases to see how the U.S. economy is really performing over the medium term.
What about where FXTM sits on this opinion? Do you think that 2 more rate rises are on the cards for this year, given what you've seen on the data front?
Now, I believe that that's the public bias that the Federal Reserve are going to continue to use, and it's definitely going to be their intention. It will take maybe 1 to 2 months more data to weaken to suggest that the Federal Reserve might alter its course, because they've been promising the markets 3 to 4 interest rate rises this year. After the letdown last year, where they said they're going to raise interest rates 4 times in 2016, they only managed it once at the end of last year. I believe that the Federal Reserve are really going to want to show their commitment towards higher interest rates and that they want stronger interest rates in the United States. So unless this data continues to weaken for maybe 1 to 2 extra months, they're still going to say 2 more interest rate rises. And I would say that it's probably likely there will be 2 more as it currently stands. But this might change depending on the data over the next couple of weeks.
Well, exactly, Jameel. Kind of 2 years of standing pat on rates. But on the policy front, we've seen Donald Trump try and galvanize growth by his slashing of business taxes. And he's also proposed a one-time tax holiday on corporate cash. For example, Apple's got $250 billion of cash on their balance sheet. So where do you think on the policy front Trump sits on this, given the opposition he has to these policies on Capitol Hill?
I'm glad you said opposition, because I think what investors in the markets are realizing right now is that actions speak louder than words. And although Donald Trump's trying to promote some very business-friendly U.S. economic policies, we have seen from Obamacare just a couple of weeks ago and also other Congress issues, such as there's a risk of a shutdown just a couple of days ago, that passing reforms and legislation through Congress is not going to be an easy hurdle. So yes, this tax plan looks very encouraging to the United States. Any economy that could cut taxes from 35 to 15% would obviously encourage businesses back towards any economy, but it's going to be difficult to pass this legislation through Congress. And let's not forget, this means increasing U.S. deficit and U.S. debt. Now, the Republicans are not known for being supportive to U.S. debt anyway, so it's going to be difficult to see whether this tax plan can actually be passed through Congress.
Well, it is a little ironic, isn't it, Jameel, given the fact that where most of the news flow is coming from, i.e. stateside, that there's also a lot of confusion, not just in terms of the funding gap, but also the healthcare bill, Trump's policies on North Korea, and all these other socio-political issues. I mean, how are you making sense of this? And more importantly, what does that spell for the US dollar's direction going forward?
Okay, so I'd start with what this means to me. What it means to me is that the political risk is going to continue dominating the market sentiment. We're talking at the beginning of the interview about U.S. economic data weakening, but what everybody's focusing on in the global media and the news headlines is Trump, Trump, Trump. Now, focusing attention back towards the dollar, it looks like investors are okay to ignore the macro front and the data for the time being. I do believe there's a risk that investors should be paying more attention to U.S. economic data. What Trump keeps saying and his administration is that they want a weaker dollar. Now, this would be very positive towards the emerging markets, and speaking to you from Malaysia, this would be positive to the ringgit. But at the same time, if Donald Trump is going to continue promising business-friendly policies, very ambitious tax plans, and other fiscal reforms, it's going to be very difficult to see how the markets won't buy into this unless they decide that Donald Trump simply can't pass through these reforms, or it's going to take much longer for them to come into action than what's been priced into the markets.
Is there an end-of-year target for the dollar then, Jameel?
I believe that as it currently stands, the dollar's looking too strong. Domestically, the economy might be able to withhold a stronger dollar, but it's not going to be good for their deficit. It's not good for exporters. I would say that I believe the dollar should dip below 100 at least a few more times before the end of the year. Maybe it can conclude the year around the same levels, but at the moment I would say it's looking more significant downside risk than further upside.
Right, below 100 then to the Japanese yen. Thank you for spending time with us. Jameel Ahmad, the Chief Market Analyst for FXTM, talking to us today from Cyprus, BFM 89.9.